Now, as the Fed readies yet another rate decision amid its battle to tame inflation, investors ponder the next steps for their portfolio. As dominance in the Magnificent Seven stocks and their impact on major indices has waned throughout the year and fixed income ETF appeal continues to grow, investors are looking out for strategies to stay on top of such an uncertain market. As part of our ETF report, sponsored by Invesco QQQ, let's bring in VettaFi Vice Chairman Tom Lydon to get his insights on how you can be investing and getting the most out of this uncertainty. Good to have you back on the show here. So help us break this down in terms of the flows that you're seeing in terms of ETFs versus some of these equity markets. What are the data telling us?
Great to be here, Rochelle. I'll tell you, usually you see about 1/5 of the money flowing into fixed income ETFs versus equity ETFs. But this year it's been almost 50-50. And part of that is, as we're surveying financial advisors all the time, most feel that a year from now, rates will be lower than they are today, that the Fed has applied its medicine, will probably have some type of recession, albeit a soft landing. But as we know, the Fed acts quickly in times of recession. It's not 25 basis points every couple of months. They'll come in with a hatchet and start slashing rates to a great degree. And even though today there's $6.2 trillion in money market funds getting about 5%, when rates cut, that yield is going to be cut dramatically, and they don't want to be stuck on the sidelines. They'd rather be longer duration. So areas like corporate credit, even high yield, as one of your earlier guests pointed out, those yields are pretty attractive these days, and we're starting to see more and more money go into corporate credit, high yield ETFs, with the idea that if they can lock those rates in for a longer period of time, and if they can be there during the period when rates get cut, they're not only getting the yield, but they're getting some appreciation as well.
So Tom, with that in mind, then walk us through some of your top picks for ETFs at the moment.
Well, a couple things. We've stepped aside from the Magnificent Seven because people are scared of the volatility and the pricing. But if you look at RSP, the Invesco S&P 500 Equal Weight ETF, that's a 1/500th allocation to each of the 500 stocks. So you don't have that huge overweighting in just 10 or 7 stocks. That's also important. The IWM, which is the Russell 2000 ETF, the valuations in the small caps today are cheap compared to large cap. You can get a PE of 10 as opposed to a PE of 20 in the S&P 500. But some of the alternatives that we've also seen have been covered call strategies. One of the most popular has been the JP Morgan Equity Premium Income, which is JEPI, JEPI. The yield there is almost 1% a month, 1% a month, while you're actually waiting for the markets to recover. Complementary strategy is a Global X NASDAQ 100, also 11.7% yield right now, where you're getting a stupendous yield, and you're also hedging your equity positions too. So those have been some of the standouts, along with quality stocks. The final one is the iShares Quality Factor QUAL ETF. Almost $10 billion have gone into that ETF so far this year. So the word is diversify outside the cap-weighted S&P 500, because that's where the value is, and that's where the diversification is.
And Tom, I want to ask you about active versus passive ETFs, because some people, might not understand the difference, and they might not really understand the flows that are going into them at the moment. Where is that money flowing?
Well, you're right, Rochelle. ETFs were built on the back of indexes 30 years ago, S&P 500, the Russell 2000, the Dow Jones Industrials. However, new ETFs have come out that have actually had active strategies. But still today, only 4% of the $7 trillion in ETFs is in active strategies. However, just last month, there was more money that went into active strategies than passive index-based strategies. And for the reasons we've kind of touched on. If you're going to buy fixed income, you don't want to buy an index, because guess what? Some of those corporations may have debt that may be subject to default or might be downgraded. So dancing around the different issues is going to be important for active strategies. And then as far as equities are concerned, buying companies that may be a big part of indexes, but might be too volatile, might be too expensive, active managers can come in and not only select what they feel are the right companies, but also the right weighting for their certain portfolio within that ETF strategy. So active is surely back, where we had about 10 years coming out of the financial crisis where it was all passive strategies. The pendulum has swung, and we're seeing more and more active managers come and offer their mutual fund active strategies in an ETF form. It's about more choice.
It's definitely important. Do your due diligence and, of course, know your risk as you're looking at some of these ETF selections. Appreciate you joining me this morning. VettaFi Vice Chairman Tom Lydon. Thank you so much.
Thanks, Rochelle.